Welcome back. So we're here with part two of my, let's call it an end of 2022 chat with Alon Ozer, who's Chief Investment Officer here at Omnia Family Wealth. So Alon, as always, again, thank you for coming back so quickly.
Thank you.
So we were talking a lot about what worked and what didn't work in 2022. We're here basically at 2023's doorstep. It's been an interesting year in markets for sure. So what are you looking at today to help us figure out where we're at in the cycle, how much risk we're comfortable taking?
We see a couple of things that are starting to happen, or a couple of things that were supposed to happen. We expected them, they didn't really happen. You have this conversation, ongoing conversation about recession, no recession, soft landing. I think it's not really relevant, and it's just a lot of talking. Whether you're going to have a recession or not, we probably are going to see a recession, right? But that's not the question. The question is how severe it's going to be. So far, we don't really see analysts lowering projections for companies, equity companies. So if we do see some more severe environment, they might need to do that, and then you're going to have equities going a little bit lower. I think it's important to understand, at least in our thinking, that what the market is pricing at this moment is mostly interest rates, higher interest rates, because as you raise interest rates, valuations should go lower. So that's what's mostly priced in, not necessarily lower earnings. And this is something that eventually will have to be priced in, unless I'm wrong, and markets are gonna companies are gonna do better. The other thing that it's very important for us to understand and look and see is what the Fed is doing, because don't fight the Fed, or the Fed already told us, guys, look, I'm gonna keep raising interest rates. By how much, we don't know. The market, you have different opinions, and the market is changing the pricing of that. But it's important to understand, because one of the most interesting things that happened this year, it started last year actually, is that the fixed income market started giving us signals of what is happening. And I know most people look at the yield curve, it's inverted, it's steepened, it's not. There's a lot of information that you can take from different parts of the curve. It's basically, you can not only figure out what the market is pricing in, but also probabilities. And if you use that, you would have had the ability to do much better this year. So it's going to be interesting to see what the fixed income market is telling us.
So I have an interesting question about that, right? So we talk about earnings, and I think stock market, right? We talk Fed and yield curve, I hear bond market. Would you say that the bond market and the stock market are saying two very different things right now?
I think so. I think so. That's an interesting point. So. And the Fed was asked about it, actually, in the recent meeting, I think. And what they said is that they asked Powell about the inverted yield curve, and he said the market is actually confirming what we're saying, that inflation is rolling over. So it could also be that the yield curve is telling him, no, there's a bigger problem that you're missing here. It's not only inflation. Right. We already know that inflation is going down. There might be something else. And I think that now we're at a very interesting point today, because the 2-year always leads the Fed, right? We know the yield starts going higher before the Fed raises, and then it goes down. And now we're at the point where the Fed fund rate and the 2-year Treasury yield are kind of at the same place. And the Fed is saying that they're going to keep raising interest rates. So we're waiting to see what the market is going to tell us, what the 2 years is going to tell us. But that's going to be very interesting.
Time will tell.
Watch.
So that's another thing we're keeping a close eye on then is the yield curve, yes, but also the shape of the yield curve and how these different parts sort of interact with each other.
Absolutely, absolutely. And just one thing that is, we think it's funny. It's the whole conversation about the Fed pivot. Okay, what is a pivot? They're going to stop. They're going to lower interest rates. They're going to. And the funny thing is that if you look at history, okay, every time the yield curve inverted, right, and then the Fed pivoted,
right,
that's when markets actually started falling really hard.
right.
It wasn't a good thing.
And is
So,
it the chicken and the egg?
beware.
Or, they're
Yes.
pivoting because things are going poorly.
Well, exactly.
And then, yeah.
Exactly. Many times what happens is that you'll see the yield curve actually steepens because liquidity evaporates, and then things starting to break, actually.
Right.
It's not necessarily a good thing.
So it's telling you something. The question is what? And it's
Exactly.
open to interpretation. That's interesting. I wanted to look ahead a little bit to 2023. Are there any, and I know it's early and we're not in the prediction business, but is there anything that strikes you as a potential opportunity in the,
Right.
in the coming year?
Right. So it's not something new. It's just that technology has been and will be, we think, a tremendous, would give us tremendous opportunities. Whether on the private side, I'm not sure so much on the public side. Public side, other markets, for example, and actually in Israel, we see a lot of something that's very interesting. Again, because of liquidity, some companies lost maybe 70-80% of their value, but they're still good companies.
Right.
They're growing, just not liquidity. So we would see that in different markets. On the private side, I think that in general, we are at the point where we're going to see some exponential growth from tech companies. When it's going to happen, because again, markets take their time, but long term, this is an area that you wanna be in, because we are seeing things that we haven't seen in the past. It's as if different types of technologies are coming together and allow us to really build something incredible.
I think it's an interesting viewpoint because, look, a lot of those technology names, public and private, got so beat up in the last year. And there's an element of don't throw the baby out with the bathwater. And so some of these names have probably been unfairly punished because of the liquidity leaving the market.
Correct. So that's 100%. And again, we don't know how long it's going to take and if it's going to continue, and if we do have a recession or a deep recession, or it's something that we cannot predict. But we do know that long term, we're going to see very good opportunities. We see a little bit right now, but we have specific companies that we follow that we want to participate, especially on the private side. But we're still waiting.
Yeah. How about maybe on the flip side, is there anything that you think, either investments or behaviors that you think investors should avoid in 2023?
I think that investors should avoid what they should have avoided this year, which is going in and out of the market. What we've seen is that many times, and it's funny, if you follow CNBC, you know exactly what not to do. People are getting very negative on equity markets, and then they become very positive because it's cheap, and then it keeps falling, and then you just can't do that. Right. This is really one of the times where your portfolio can get destroyed. So that's something that you shouldn't be doing. I think that if you have the ability to add some exposure to volatility, is something that you want to do. And it's interesting that with all the drawdown we had with equity this year, volatility actually didn't do that well. So it might be an opportunity for next year. So small exposure could be nice addition. And in general, actually, I think the most important thing for investors to do, and we actually wrote about it in the past, in the last 2 years, and this is getting critical at this point to do it, just take a step aside from the idea of diversifying with asset classes, because it's not going to work. It didn't work this year. It's probably not going to work if we do see those changes. You have to diversify your portfolio based on macro factors. The best example that we have is the fixed income and the equities.
Yep.
You thought you were diversified, you were completely wrong, and you got hurt badly. Macro factors are the most ideal. It's the most ideal way to diversify your portfolio nowadays, and I would say long term. But this is the time to change it if you haven't thought about it before.
That's great. So, Alon, I always love these conversations. I learned so much from them. I want to thank you. I'm sure everybody appreciates it too.
Thank you.
Your time and your insight today. And I want to thank everybody for watching. So thank you. And thank you,
Thank you,
Alon.
everyone. Thank you.
Thanks so much for watching. As always, make sure to rate, review, and subscribe. You can also find more content on our Omnia Family Wealth YouTube page, or check out our latest videos by clicking on these links.